Imagine a global gold rush, bigger than anything we've seen before. But what if I told you there's a powerful economic force that could stop it dead in its tracks? Well, that's the dilemma we're digging into today. So let's get right to it. This is the question on everyone's mind. Could gold really hit $4,800 an ounce? Is this just hype, or are we about to see a historic shift in how we value gold? Now look, that number, $4,800, it's not just pulled out of thin air. We're talking about a serious forecast from major players like Morgan Stanley, and they're looking at the year 2026. I mean, a price that high would absolutely shatter every record we've ever seen. It would completely change the game for precious metals. So the big question is, what's going on behind the scenes to even make this a possibility? All right, to figure that out, we've got to zoom out and look at the big global picture. Because right now, there are some really powerful forces brewing up what you could call a perfect storm for a gold boom. Okay, so what's in this perfect storm? Well, first off, you've got falling U.S. interest rates and a more relaxed Federal Reserve policy. Think about it. When interest rates are low, holding cash that earns you next to nothing doesn't seem so great, right? Suddenly, holding gold, which doesn't pay interest anyway, becomes a much smarter move. Then you've got central banks all over the world. They're buying up physical gold like crazy to become less dependent on the US dollar. That's a huge shift in global finance. And of course, whenever things get tense in the world, geopolitically, investors do what they always do. They run for safety. And safety often means gold. All of this just drives demand through the roof. But hey, it's not all about demand. We also have to talk about supply. And this quote from the Economic Times really hits the nail on the head. Miners are having to dig deeper and move more dirt just to get the same amount of gold. It's just getting harder and more expensive to find. So just as demand is about to take off, production from the big mining companies is actually expected to fall. And that difficulty, it directly translates to cost. Get this, for the big miners in North America, it costs them around $1,600 just to get one single ounce of gold out of the ground. That number creates a really solid floor for the market price. Yeah, there's actually an industry term for this. It's called the all-in sustaining cost, or AISC for short. It's basically the total cost, everything from mining and processing to admin costs to produce 1 ounce. It's the bare minimum price miners need to just break even. So, what happens if the market price falls below that? Well, it's simple. They just stop mining. Supply dries up, and guess what? The price gets forced right back up. Okay, so we've seen the global picture, but now let's zoom way in to what you might call the cultural epicenter of the gold market, India. Because if you really want to understand gold, you have to understand what it means in India. See, in India, gold isn't just some number on a screen. It's woven into the fabric of life itself. It's a huge part of weddings and religious festivals like Diwali. In fact, something like 85% of all the gold bought there is in the form of jewelry. This creates a kind of deep, constant demand that you just don't see anywhere else in the world. But, it's not just about culture. There's a really practical economic reason for this obsession. A massive chunk of India's population, about 2/3, lives in rural areas. And for a huge number of them, we're talking maybe up to 60%, they just don't have access to a regular bank. And that's where gold steps in and plays an absolutely crucial role. If you can't just go down to the local bank, physical gold basically is your savings account. It's a trusted, tangible asset that you can hold in your hand, and it holds its value. For millions and millions of people, it's an essential financial tool. And you know what's interesting? This love for tangible, physical assets isn't limited to just gold. We're seeing a really similar boom happening in the diamond market, and it gives us a much bigger picture of what's driving consumer behavior in India. Just check out these numbers for a second. The diamond market in India is just exploding. It's projected to grow by more than 50% in the next decade alone. This tells us there's a broader trend here. Incomes are rising, and with it, the demand for luxury goods is too. So what's fueling this diamond boom? Well, it's a mix of a few key things. You've got supportive government policies helping out, big jewelry stores are pushing out beyond the major cities into smaller towns, and you have a new generation of millennials and working women with more money to spend. And on top of all that, there's the whole new sector of lab-grown diamonds, which is really shaking things up. Okay, so far, it sounds like a one-way street, right? Demand is soaring, supply is getting tight, but now it's time for a reality check. Because there are some serious economic headwinds on the horizon, especially in India, that could throw a wrench in the whole thing. To get a handle on these challenges, we need to talk about something called the current account deficit, or CAD. The easiest way to think about it is like your own household budget. If you're spending more money on stuff you're buying from outside, that's imports, than you're earning from what you're selling, your exports, then you've got a deficit. And right now, India's deficit is growing. How big is it getting? Well, a major rating agency, ICRA, is projecting it's going to widen to about 1.5% of the country's entire GDP. That's a pretty clear signal that the economic balance is getting a little shaky. And that imbalance puts a ton of pressure on the local currency, the Indian rupee. It's already been weakening against the US dollar. Now, why does that matter for gold? Because gold is priced and traded in US dollars on the world stage. So a weaker rupee automatically means gold gets more expensive to import. So just imagine you're an average person in India looking to buy gold. This is like a double whammy. Even if the global price of gold stays exactly the same, a weaker rupee means you're going to be paying more for it in your local currency. The price at home just keeps creeping up. And if that wasn't enough, there's one more hurdle. The Indian government has slapped a 6% import duty on gold. They're doing this to try and get that trade deficit we talked about under control. But the immediate effect? It just makes gold even more expensive for the people buying it. So where does all of this leave us? Well, we're basically watching a massive economic tug-of-war. You've got two incredibly powerful sets of forces, and they're pulling the price of gold in completely opposite directions. On one side of the rope, you have all those global drivers we talked about: easy money, geopolitical risks, central banks buying everything up. All of them are trying to launch the price of gold into the stratosphere. But on the other side, you've got these very real local economic headwinds in India: the weaker rupee, the trade deficit, the import taxes, and they are pulling with all their might to drag that price right back down to earth. And that sets up the ultimate question, doesn't it? When these massive global price trends collide with the hard reality of a local economy, which one is going to bend? Is that deep cultural demand in places like India strong enough to overcome these hurdles and power a new global gold rush? Or will the economic reality on the ground be the pin that finally bursts this massive bubble? The answer to that, well, it could be worth trillions.